So we have a lot of clients asking about global issues, and maybe I can get the thoughts of Zach here, especially on the first part of this question. What are the advantages or disadvantages in investing in global investment instruments? Any comments here, Zach?
Yeah, I think it goes back to some of the comments that I made before. I think there's a few things that stand out to me that stand the test of time and certainly sit at the core of how we think about building our portfolios. And these are old adages for investors, but they certainly are very important in not putting all your eggs in one basket. So having a wide opportunity set, again, we think is important for two reasons. But the first and most important is when you're trying to generate income and return, it's a way for you to diversify risks. So you're not just concentrated in, say, one sector or one stock or one country, but rather you take risk in a variety of different areas. And oftentimes those risks move in opposite directions. So when one thing's not working, this other thing might. And that's a good way to help build portfolios. The second is also just from the more opportunistic standpoint is it allows you to go into areas that you deem to be attractive and can generate more competitive income and return than being maybe concentrated into just one specific market. So for us, it really is kind of that combination of having a wide opportunity set to be able to manage risk, but also take advantage of different opportunities and do so on a global basis. I will just maybe, sorry to draw on here, but I will make just one plug for BlackRock, because I think this is an important distinction here, is that when you are investing in global markets, the resource part of this is really important. That it's hard for any one individual investor, or frankly, one individual investment team, to have expertise in all of these different markets. So you need to have a wide set of resources at your disposal to be able to tap into these different markets. And for how we think about building portfolios and being at BlackRock, we certainly have that at our disposal, where we work with investors that sit across the globe that cover different markets. And that's incredibly helpful when we think about our portfolios.
Yeah, and I guess it's all about having a different kind of exposure, especially if we take a look at the second part of the question, comparing it with local stocks. Of course, the behavior of investment instruments abroad would be quite different to what we're seeing here in the local market. So there's definitely room for both. It's not an either or equation at the end of the day. Then, Zach, there's another question here on China Evergrande. So for those people who are not familiar, this is a company that recently hugged headlines for its amount of debt. So how do you think will this affect the global landscape?
Yeah, it's this has certainly been in the headlines for, but it's actually been going on for some time now. It's been going on for the better part of the last year or so. And this is related to the Chinese property market, and it follows tightening policies by Chinese authorities. So it's been a little bit deliberate by them to try to get some of that property market under control from a debt and leverage standpoint. So some of this is not to be unexpected because of some of those tightening policies. But just a few important points here. The first thing I would say is the transmission channels of this getting into other global markets, we don't see them there. So we don't think of this as kind of a systemic event that's likely to take down the whole global economy or anything like that. We think of this as something that's a bit more country and sector specific. But I will say the reason that markets are really paying attention to this, or global investors are really paying attention to this, is because China is an important driver of global growth, and property is an important component of their growth. And so if that's likely to weigh on China growth, that has implications for broader global growth. So that is something to pay attention to. But again, we don't think of this one individual event as something that's going to leak into the rest of the global markets. The other couple points I would make quickly, the China regulatory clampdown has certainly pushed on the last couple of months or so, but it really can only push so far. And we actually see them shifting a bit more to easing some of their policies, prudently, not like massive stimulus, but prudently easing some of their policies. And just for reasons for this, if you look at their first quarter growth, it was 17%. If you look at their second quarter growth, it was 7%. if you look at their third quarter growth, it's expected to be around 5, but maybe that's even lower. And Q4 may be closer to 2%. And so the growth has been coming down, so they can only push this so far. So we actually see them starting to ease some of their policies, which should help some of these headline risks that you're seeing come out of China. And the last thing I would say is that we do think there will be elevated volatility around China in the short run here, and sentiment can drive markets in shorter time periods. So we are a bit more cautious on this, but like I said, we ultimately don't think of this as a spillover into global channels. We just don't see the transmission channels being open to that specific kind of company and that specific sector in particular.
How long is the recovery period of the equity market during this pandemic? And perhaps just related to this, can you also comment on questions about any bubbles bursting in the US?
Yeah, it's a good question. So a couple thoughts on this. The first thing that I would say is it's pretty clear to us that this time around is anything but normal in terms of what the recession has looked like, because it was triggered not necessarily by financial financial event. It was triggered by a pandemic. And so what happened this time around was both one of the quickest recessions we've ever seen, and then the quickest recoveries we've ever seen because of that pandemic. And part of that was a function of the pandemic and then the policy response that we saw from central banks and governments. The same thing could be said for equity markets, where we saw the fastest ever bear market last year, and then the fastest ever bull market in terms of how quickly we rebounded there. So it does seem like in some ways these cycles have been a bit more condensed than they have in the past. But generally speaking, recessions are often way shorter than the recovery periods. The recovery periods tend to last years, if not potentially even longer than that. And then the recessions tend to be much shorter than that. And so the one thing that I would note is that, we still think from an economic growth standpoint, we're actually still in kind of the early stages of this recovery. Now, yes, there's some risk from the virus, but ultimately we think the reopening that's been happening, there could be some delays along the way, but that just pushes growth out to next year. And so we think we could still be on this path where you're going to see reasonable growth, even if it does moderate, which we expect it to, but ultimately it's still going to be in positive territory. As it relates to the second question around bubbles, definitely I would say pockets of markets that are looking expensive, and we would argue it is a function of some of the policies that you've seen happen, where if you think about the Federal Reserve and what they're trying to do, they're trying to get the economy to take on risk to help recover from an economic activity standpoint. So the way they do that is they reduce the cost of money. And so by reducing the cost of money, consumers want to take out loans, companies want to take out loans, they want to do big investment projects. It's easier to do those things. But also one of the side effects of this is that it tends to have a pretty big impact on markets as well, because there's more liquidity in the system. So I don't want to call this we don't want to call this a bubble, because we still want exposure to these things, but it's really hard to get excited about, I would say, government bonds at where they stand today. When you just factor in, looking at the US, inflation has been trending, in the 3 to 5% range, and government bonds yield 1.5%. So that you're barely making a dent into what inflation is by owning that asset class. And so that's something that we just don't think makes a ton of sense to own in isolation, but we still want to own some for the downside benefit. The other thing that I would just note is that as interest rates start to move up, some of those really aspirational growth companies, so these were really big in focus in 2020. And what I mean by that, these are companies that had no actual earnings. So companies that were not profitable, but they had some idea that they could be profitable in 5 years' time. And investors really got attached to those kind of ideas in 2020 and bid up those stocks to pretty high levels. what tends to happen with those kind of companies is, one, they either become successful and they actually have earnings, or if you start to see interest rates move up, then that actually puts pressure on those companies that are really long-term in nature growth companies that actually don't have any earnings. So that's when it goes back to the point around, we've been focused on quality stocks, and the simple way that I think about that is, we want companies that actually have good current earnings today, that have not too much leverage or debt on their balance sheet, and have the ability to pass along some of the pricing pressure that we've seen happen in markets. We think those are the sweet spots for where investors should be focused as it relates to markets.
Yeah, and you mentioned inflation and interest rates already, Zach. So perhaps I can rephrase the third question here and relating it to the actual investment experience of our audience. With inflation, as you mentioned, staying elevated for the near term, on balance, for income investors, should they expect that yields would be better or lower going forward?
Yeah, it's as income-oriented investors that we certainly still invest a lot in bond markets globally. So we're always asking ourselves the question on the direction of interest rates. I would maybe think about this in two ways, though. The first is looking at longer-term interest rates. So what I mean by that is, if you look at something like the U.S. government's 10-year bond, or they have a 30-year bond, so long-term interest rates. Long-term interest rates are driven really by a function of what inflation is in an economy and what growth potential is in an economy, amongst other factors, but those are some of the big driving factors. If you're in a healthy economy, ultimately that should be reflected in interest rates. You would expect higher interest rates. So we do think longer-term interest rates will drift up from here. But we're not in the camp that they're going to shoot up meaningfully higher. We've certainly seen yields in the US move up within the last couple of weeks, but for some perspective, 1.5% is well below the average that we've been over the last 10 years pre-COVID. So we're still very low from an interest rate standpoint today, but we do think they could edge up from here because of some of that growth and inflation impulse that we've seen. In terms of short-term interest rates, so think of things like 3-month treasury bills or very short maturity bonds. That's what the Federal Reserve has the most influence over. And so when they cut interest rates, or central banks globally, when they cut interest rates or even move interest rates into negative territory, they're really focused on that really short-term interest rate. We expect those to be anchored at low levels for the foreseeable future. And so we think that central banks talking about moving interest rates up, we really, at least in the US, we probably don't think that's happening until at least 2023. And so we still think we're going to be in an environment where short-term interest rates are going to be really, really low, zero or negative, where longer-term interest rates are still really low, but likely could drift up from here. And so for I think the takeaway for investors here is that, one, there's not a lot of income and return potential in these kind of really very rate sensitive areas of markets, think like the US Treasury. And when you factor in the idea that interest rates could move up, that's going to be a headwind to those areas. And inflation is already elevated. That's an additional headwind to those areas. And that's why we've not been super optimistic around holding a lot of that exposure in our global portfolios.
And I guess relating it to one of your slides earlier, Zach, we saw a lot of cash still waiting on the sidelines. So I guess for investors who are in the same position, maybe it's really time for them to look for better yielding instruments. Dom, I think there are clarifications about the return of the fund. Can you answer this one? Is the return guaranteed? And how can you earn regular income from this investment?
So of course, the return is not guaranteed given this invest in different securities. But I think from the track record of the target fund and also of the feeder fund, which is ALFM Global Multi-Asset Income Fund, it's been proven that it's been able to give consistent dividend yield on a monthly basis. Now, how the regular income is earned, this is through dividends. For the feeder fund, we issue unit dividends which in turn is automatically redeemed.
Yeah, and I guess the second question is pretty much related to that. So if you're invested in the fund, as Dom mentioned, you can expect to get that kind of monthly dividend by way of cash distribution in your COL account. So I'd like to emphasize that one for our audience. You can already invest in this fund through your COL account. Okay. And Dom, on the third question, quick comment on this. What is the difference between this fund and other existing funds? Maybe you can look at your own plate since you have different types of mutual funds in any case.
Yeah, so for this one, no, well, it's a feeder fund. It's the first, no, in the country. It's also the first to offer, no, regular dividend payouts in the mutual fund industry. And if I'm not mistaken, it's also the one that it's the most frequently, it has the most frequent payout, no, in the industry at the monthly. So I think this is one of the key difference, no, of these funds amongst other investment funds in the country right now.
And correct me if I'm wrong, Dom. The fund is more on the income orientation rather
Yes.
than capital growth, right?
Yes.
So, yeah, for our clients who are so used to stock investing, so if you're looking for capital appreciation, there could be other funds or other instruments that may be more suitable for you. This one is really a fund that will give you regular income. How is the fund invested again?
Well, for the ALFM fund, it invests 90%, no, into BlackRock's Global Multi-Asset Income Fund. I think Zach can explain, no, the allocation of the target fund better.
Yeah. So in terms of the asset allocation or how we invest the portfolio, I would say there's kind of three main buckets that we invest in. The first is a traditional fixed income bucket or a traditional bond bucket. So think of these as kind of government bonds and corporate bonds in developed markets. It is kind of your traditional equity income bucket. So think of these as global dividend paying stocks. So companies that pay regular dividends to their stock owners. And then the third bucket is we characterize as more complementary income sources. Now, these income sources are either a bond investment or a stock investment, but they're not necessarily traditionally owned in regular income portfolios. And we use these as, going back to some of the initial points I made, for diversification and for income benefit. So examples of these would be things like global REITs or real estate investment trusts. So these are stocks, these are listed stocks, but their businesses are involved in real estate globally. So they tend to function a bit differently than your traditional stock or bond investment. So having exposure to that, we think, helps from a diversification standpoint. These are also securities that tend to have pretty nice dividend yields to them. So for our portfolio, where we're trying to deliver consistent income, we think that makes sense as well. Another example of this would be on the fixed income side. It would be more kind of emerging market debt exposure, which tends to have a bit more volatility, but because it has more volatility, also has a bit more income potential. So investing in areas like Asia and the fixed income and bond markets here in Asia, we do think makes sense for global portfolios to have some exposure to that. And we do in our current asset allocation today. So again, in the three buckets, a traditional fixed income bucket, a traditional equity bucket, and then we have a big bucket of complementary income sources, which we use as a way to diversify and meet our income objective.
What's the risk profile of the fund, and would this be suitable for those in their early 60s about to retire?
Well, the fund, no, is classified as aggressive, no. But if you look at how it's managed, no, it's managed in a somewhat in a moderate manner, no. Given that its primary consideration is the risk rather than the performance, no. But for us, no, most of the investors that we have are those actually retiring or retirees, no, who would want to have a more passive or income, no, throughout their retirement.
Yeah, so it's aggressive in nature because of its global exposure, but doesn't necessarily mean that if you're 60, you're older, it's not something that can be part of your portfolio already. So as mentioned by Dom, if there's a need for you to have that kind of regular income, I think it's something that you can take a look at. And that's probably related to the next question also. Ultimately, it will depend on your need. So if you're looking for this kind of investment, the one with regular income payout is something that you can take a look at. The third one, I think we already covered that one, so we can move on to the next question. All right, so we have a lot of questions about this one, management fees and exchange rates. Perhaps I can get your comment on this first, Dom. How can I maximize my investment while minimizing cost, fees, and higher conversion rates, especially when investing in funds like this one?
Yeah. So for us, though, of course, it's the target fund would have its own management fees, no, on top of the feeder fund. However, what's good, no, for us investing as an institution to the target fund, no, we're able to get the institutional class, which has a significantly lower management fees, no, thus reducing, no, the cost to the investor. Just to give you an example, if I'm not mistaken, the retail class of the target fund is at around 1.5%, whereas the total fee of the feeder fund and the target fund institutional class is only at 1.6. No, so I mean the spread is not that different. It's very negligible.
Yeah, so in other words, the fund has competitive fees. No? But Dom, going to the question of this person, I think we can relate it to usually how stock investors do their investment activity, whereby some of them may be buying and selling. And with this vehicle that we're talking about, it's fund, primarily a fund. Do you think that kind of approach would work also?
Yes, I think especially if you would want to invest offshore, again because if you would want to go direct securities offshore, it would require higher capitalization, of course, and then there are licenses that are required to be paid. At the same time, there are costs, not just brokerage fees as well, given that you will have to do it with brokers licensed abroad. No, so it tends to the cost tends to pile up. No, whereas if you invest through a fund, no, a feeder fund, you're able to minimize the cost given the bargaining power of the institutional fund.
Yeah, and then maybe we can go to the third one, Dom, since we already touched on the second one. I asked about this element earlier, but if we can just repeat it. So, as I understand it, the peso class has exposure to the exchange rate movements. How will the investors feel that one again, Dom?
Well, when especially for investing in the peso class, normally how we do it is that it's just an outright conversion, no, of the dollar or the feeder fund itself, which is a dollar, to the peso class. So of course, if the dollar is expected or is strengthening, then there's an additional return on the FX component or conversion. Whereas of course, if the peso is weakening, no, then there's also losses.
Yeah, but at the end of the day, Dom, just to clarify it with our audience, the way they will feel it is still the same as with other funds. It's through the movement in the net asset value per unit in this case. Yep. So, ladies and gentlemen, you don't need to actually do any conversions or what. Just take a look at the trend of the fund price. So, that's how the earnings or paper losses will be derived. Okay? So if we can move on to the next set of questions, please. All right. So actually, we have a lot of questions similar to this one. They're trying to compare the fund that Dominic mentioned earlier versus other investment offerings that we've seen recently, specifically REITs. So we have a lot of REIT offerings lately. So Dom, how would you compare this fund, the ALFM Global Multi-Asset Income Fund versus the REITs? Because REITs are also, as you may know, income paying instruments as well, right?
Yeah. So yeah, that's correct. No, it's income paying. However, no, they derive their income only on one source of asset class or the rent that they generate from the property. Whereas the the target fund or the feeder fund, no, it's diversified, no, across different asset classes. Thus, cushioning, no, providing some kind of cushion, no, if there's any adverse effect on certain sectors in the economy.
Yeah, and I just want to add, based on what Zach earlier mentioned, if you would recall, this fund is also invested in REITs, no, in
Yes.
other parts of the world. So it's just more diversified compared to the REITs that we are seeing here in our local market. All right, so can we go to the next set of questions? Okay, investing advice in general. So, can a small investor like me invest in global funds? So, I think the answer to that is quite clear. So, with the funds being offered by our partners at BPI and hopefully other funds in our platform, definitely you can access global investments already. And maybe Dom, you can comment on this. What is the best mutual fund for a beginner? How should a beginner go about his or her investment journey to begin with?
Well, of course, the investor would have to assess himself first, no, how much risk he's going to take, his investment horizon, no, because a beginner investor doesn't necessarily mean that he's young or just starting out, no, with the investment journey. So it really depends, no. But for us, normally what we advise to our clients, no, just starting out with the investments, no, in mutual fund, is to start off more on the conservative side and then gradually build up the portfolio with other asset classes.
Yeah, maybe I can get the thoughts of Zach. Zach, a lot of our attendees right now, actually, they are first-time global investors, if ever. There's any advice that you can give to these guys who are trying to dip their toes into the global investing landscape, what would that be?
Yeah, it's a really good question and certainly an important one. I would say the first thing is know what you buy, know what you own. So I think that's really important in terms of just making sure you understand the risk and benefits of different strategies. I think that's really important for first-time investors. I would say the tenets of what we do are applied to a lot of different strategies as well, of diversification and risk management. Make sure that those are things that are being discussed when you're kind of thinking about different investment strategies. The second piece of advice is markets do change, and there is an element of volatility in markets. And I find myself subject to this in my own personal investments and trying to be too short-term in nature. But that ultimately works against you. And I think it's really important that when you do invest in global markets, to not necessarily think about this in a 3-month, 6-month time horizon, but think about it over the course of a couple years. And that makes sense, especially for the investors that are in retirement that ultimately have a long set of years that they have to support their lifestyles. Investing should be thought of in the same way. So I would say make sure you align risk and know what you own, but also think about appropriate time horizons and taking a little bit of a longer term view, I think ultimately leads to more success.
Right. So very practical set of advices. So I think we have a lot of questions yet. So we've already covered the advanced questions. So maybe we can take a look at some of the questions sent in by our audience this afternoon. Okay, so how often will the components of the fund be reviewed and changed if necessary? So maybe, Zach, I can ask you to comment on this.
Yeah, so the fund is dynamically managed, or the strategy is dynamically managed. So that means we are constantly looking at our allocations and our exposures. So as an investment team, we're thinking about markets on a daily basis, and If we need to make changes in our portfolio to align the portfolio to changing market conditions and our current investment views, we can do that on a daily basis. The one thing that I would note, though, in terms of how we think about managing these portfolios, we are also cognizant that we don't want to be swinging the portfolio around because there is risk in doing that, because you can be wrong in your investment view. And if you take a big swing in one direction and you're wrong, that can work against you. And so we are prudent in the way that we do make changes in the portfolio. And so I like to say that our asset allocation process and how we think about the portfolio is more evolutionary in nature and not revolutionary in nature. That if you look at our strategy over the course of time, it certainly has changed. But this is not a strategy that's going to be 100% stocks, 0% stocks, because we think there's a lot of risk in doing that. But rather, we will evolve our exposures as market conditions change.
Yeah, and I guess the way you describe it, Zach, I hope the audience can have an appreciation of what it is, or what is the benefit rather of having a fund manager, an active fund manager like yourselves, especially you looking at the markets on a daily basis. When the NAVPU of ALFM Global Multi-Asset Income Fund goes down, would that have an effect on the dividend yield of the fund? Given the weakness in US stocks now, would there still be an upside 6 months, or would you rather wait to bottom? Maybe we can ask Zach for his comments on the second part. Dom?
Basically, for us at ALFM, we give out everything that we receive from the target fund. So I guess it is better for Zach to answer, especially on the impact on the NAV on the US stock.
Yeah, so
exactly.
same answer there. It's no in the sense that if we buy, say we buy a bond and that bond pays income and that bond goes down in price, we're still getting the income. We still have income that we're getting into the portfolio that we can pay to our investors. So the actual yield of the portfolio won't necessarily change just because of market volatility. Now, it could change if we are making changes to our exposures in the portfolio because we are trying to do things either to take up risk or take down risk that could impact the overall dividend yield. But in terms of just the market movement of different prices, you would expect the yield to be rather consistent because we're collecting those things. And the price volatility on these things doesn't necessarily impact the income that you could earn. In terms of the second question around weakness in US stocks, as I mentioned, we just got done with a pretty weak September for global stocks, and certainly a little bit of a seasonality effect to this because September has historically been a weak month. And I was also mentioning that we do think volatility is likely to stay a bit elevated here, so the markets could be a bit choppier here. I think it's difficult to say in the next 6 months whether there's going to be a better time to buy, but we do think there's a bit more volatility here. And one of the simple things that we advocate for is if you have an allocation that you'd like to make to a certain strategy, when there is volatility like this, you could kind of average into that strategy. So instead of kind of buying everything that you want to today, you buy it a little bit today, a little bit in a month, a little bit in 3 months. And that helps diversify the timing that you get into markets versus doing it, say, in one specific day. That's what I do personally as well. I think that's a good strategy instead of trying to specifically time these things. The last point I would make is just on our strategy in particular, because it's so well diversified, it's not like you're buying just a few stocks that you really have to worry so much about getting that timing right, because it is a very broadly diversified portfolio. And just to put some numbers behind this, the strategy, the target fund here has over 4,000 individual stocks and bonds inside of the strategy. So as we've been kind of mentioning along the way, it's very much diversified by design. And I also think that's one of the simple ways that you can hedge or mitigate some of that timing risk that investors think about when they are investing in markets.
Yeah, thank you, Zach and Dom. So basically for us investors, might be best that we just cost average as long as it's within our portfolio needs when we continue investing in these types of funds. Can we move on to the next question? I think we still have a lot from our clients this afternoon. You mentioned earlier that these are high dividend funds. Are the dividend pay out in cash or recycled back to the fund to buy units? So, Dom, can you just clarify again? How will the clients receive the dividends?
So the clients will receive dividends in the form of additional units, which are automatically redeemed, to the client.
Yeah, so in other words, they get cash, Dom, right?
Yeah, the end state is cash. Yep.
Yeah, and for our clients, if you are a COL customer, what will happen is the dividend from the ALFM fund will be credited to your buying power. Okay, so much like any other dividend from listed stocks. Can we move on to the next question, please? So in the history of the fund, was there a time you weren't able to pay any dividends for a whole year? If so, how is your group managing this risk? Maybe Zach, you can comment on this.
In terms of the underlying strategy, the answer is no, because again, it goes back to the way that we built the strategy is, I think that question would apply if we were buying, just to give an extreme example here, if we bought one bond and one stock and that bond defaulted and didn't pay you income, and that company cut their dividends to zero, you weren't able to pay a dividend because the two things you owned didn't have any income. But we don't invest like that. We invest across a number of different markets and securities that are constantly generating income in the portfolio that we can consistently pay out to our investors. And so, again, the design of this is very deliberate for both the risk side of things, but also recognizing there's an element of consistency that we want to meet as it relates to the income. And so having a lot of things that are consistently paying income into the portfolio will allow you to meet that income objective in a variety of different market environments. And over the course of our history, we've done exactly that.
Yeah, so very clear. So as mentioned by Zach, it's something that most likely we can expect to give us really regular income payment on a monthly basis. Can you go to the next question, please? Okay, when can an investor expect his or her first dividend? A month to 6 months from initial investment? Dom, maybe we can just clarify the logistics. I understand there's already a regular schedule for this fund in terms of payouts. Maybe you can describe it to our clients.
Yeah, so the fund has a record date, as of every month end. So if you are invested at month end, you are entitled to receive the dividend, which is paid out 15 days after the record date.
All right. So again, as mentioned by Zach and Dom earlier, the fund tries to give out monthly income payment. So we are going to notify clients if the dividends are about to be credited to your account. So every month end, as mentioned by Dom, it's the record date, and you can expect within the next 15 days after that month, the cash or the equivalent dividends will be credited to your account. Okay, so can we go to the next slide, please? Next question. With bond prices drifting lower as the 10-year yield in the US moved back to 2%, how will this impact the NAV of your fund in the next 12 months? So, Zach, maybe quick comment. I understand, as you mentioned earlier, the fund is well diversified, but would this kind of move have any significant impact on the performance of the fund?
So, a couple thoughts on this. The first thing that I would say is most of the portfolio is not invested in the areas of bond markets that are most sensitive to these interest rate movements. So just to dive just a little bit deeper into this, that the fixed income or the bonds that we do own, they tend to be more corporate bonds, that the performance of that corporate bond oftentimes has a lot more to do with how well the economy is doing and how well that company is doing from an earnings standpoint. And if those things are working well, that bond price will generally do pretty well. And so we have focused on sectors and bonds that are like that aren't terribly interest rate sensitive in the makeup of this portfolio. So in terms of how we would be impacted by this, there's a little bit of an impact on that, but most of the price or performance of the things that we buy in bonds is not dictated by interest rate movements. It's more dictated by, again, how the economy is doing, how the underlying company is doing in terms of its earnings, to kind of simplify this. The second thing that I would note is in terms of our current positioning. So if you look at what our interest rate sensitivity is today, and so one way to measure this is through duration. And so duration is a financial term that ultimately measures how sensitive your portfolio is to interest rate movements. So if you have 5 years of duration, it means if interest rates were to go up 1%, you would lose 5%. Our duration of our portfolio today is 1.2 years in aggregate, which is at a historic low for how long we have been running this strategy. So back to the points I was mentioning before of we don't want to own things that have a lot of interest rate sensitivity, because we do think interest rates are set to move higher here. Now, we are not immune to that risk, but we are seeking to mitigate that in the portfolio. And as I mentioned, we're running historically low interest rate sensitivity inside the strategy today because of some of those views.
All right, thanks, Zach. So I think we still have a couple of questions left. Can we go to the next one, please? Okay, this is specifically for you, Dom. How much, again, is the management fee and the BlackRock management fee? So I think you mentioned this, but just to refresh the minds of our audience.
Sure. So for us, the local management fee is at 1%. And then we are invested in the institutional class, which has a management fee of 60 basis points.
And just to clarify, Dom, because I think some of these people might be thinking, would the 1% be deducted, let's say, from the dividend yield or what? How would the management fee be felt by these clients?
Yeah, so similar to any other fund, it's part of the daily NAVPU, since this is in units, so it's part of the daily NAV, net asset value per unit.
Yeah, so the dividend yield, for example, that you showed earlier, the 4.3 thereabout, that is already taking into account the management fees, correct?
That's it, yes.
Yeah, so again, ladies and gentlemen, you don't deduct the management fee from the yield that you're seeing. Okay, so do we have some other questions left? Okay, so developed countries are starting to rebound from COVID. However, some developing countries are still lagging behind, particularly those affected by logistical issues around the manufacturing sector. Which industries do you foresee are more resilient to this type of environment? Maybe Zach, I can ask you to comment on this question.
Yeah, a couple thoughts. The first thing that I would say is, again, as global investors, we could invest in developed and developing economies. Most of the exposure that we have today and throughout our history has leaned towards developed countries, and the US in particular. But today in particular, we are a bit more cautious on emerging markets or developing economies because of some of the COVID risks that exist, but also because, as I mentioned earlier on, China and some of the dynamics that we're seeing out of China, where it's a bit slower from a growth standpoint. There's some of those regulatory issues that are still playing out here. There's some of the property uncertainty there. And China is a big, important part of most emerging market indices and exposures. And so with that, we have been generally a bit more cautious on emerging markets. Industries we foresee here, maybe a different way to phrase this that I think is a helpful one of when I think about last year, what worked really well is I like to think about this in the virtual world worked really well last year. Like, so if you bought Zoom as an example, as a company, that it worked really well because everyone was doing doing things remotely, even though they're still doing that this year. And then there's kind of the physical world of like brick and mortar retail. So you actually go to a store. That stuff was under tremendous amounts of pressure during COVID because of obviously economies were shut down, so people couldn't go out and operate as they normally do. Today, we're at kind of this interesting juncture where we think it kind of makes sense to have exposure to both. So things that are a bit more cyclical in nature, so tied to kind of some of that reopening momentum, but also things that are still kind of in that virtual or tech world, because we think those are kind of longer term themes that will continue to play out over the course of the next several years that we want to have exposure to. But I don't think it's as dominant of a theme as we saw in 2020 when everyone was working from home and you only wanted to own those certain kind of growth oriented securities. I think it's more of a bit of a balance between owning things that are going to be tied to reopening. So that's kind of some of your more traditional sectors of think of just, again, brick and mortar retail, things like that, as well as some of those, the tech parts of markets, which will be kind of more secular trends, is how we think about kind of building the portfolio in terms of positioning across, particularly across stocks today.
Yeah, so I guess that's the kind of new world that we're facing, is a bit of balance between the traditional industries and the new ones that we saw in the course of the pandemic. So I guess for the sake of time, this might be the last question that we can entertain. As I mentioned earlier, for those unanswered questions, we'll try to get back to all of you via email. So again, thank you everyone for sending in your questions. Once again, we would like to thank Zach from BlackRock and Dom from BPI Investment Management for sharing with us their time and insights this afternoon. Thank you so much, gentlemen. As we've heard from Zach this afternoon, diversification is important in today's market. But to connect it to your individual portfolios, we shouldn't just diversify for the sake of doing so. Instead, we have to be very deliberate about it in order to meet our specific needs. So what you need to think about now is, what portion of your portfolio should you allocate into this type of income investments that we've learned this afternoon? Should it be 20%, 30%? Ultimately, as I said earlier, it will depend on your financial goals. So you have to think of your personal needs. A lot of you here are in your 30s, 40s, or 50s. That's usually the time when we have a lot of cash flow needs. But even if you are younger, I'm sure you still have such needs, so we have to consider them when building our portfolio. Second, we also have to remind ourselves that returns are not everything when it comes to investing. A great majority of you here are what we call traditional investors. Most of you use funds or income instrument to actually build your wealth. And so we must believe that owning a steady investment is a very important part of our investment journey. And having a global fund manager, perhaps like BlackRock, with an extensive coverage and reach, can help us minimize extreme risk, especially when we start investing globally. And finally, even with the availability of similar instruments like REITs, preferred shares, it's not just the yield that matters, but also the regularity of the payouts and the overall diversification that an investment can provide you. So in that sense, for investors who are looking to fill their need for an income-paying instrument, there should be a room for a fund like the ALFM Global Multi-Asset Income Fund in your portfolio. After all, it is among the very few instruments in the country with monthly dividend payouts and global exposure at the same time. Okay, so before we formally close, just a few more announcements. I'm happy to actually share that BPI Investment Management is going to give the first 100 investors with at least 50,000 investment in the fund starting tomorrow an additional investment credit of 500 into the fund. So the additional investment credits will be given to you as additional units in your COL portfolio. So you'll be duly notified if you are eligible to receive this bonus. So again, 50,000 pesos minimum investment, you'll be given an additional 500 peso investment credits to the same fund. So we'll share the mechanics in our post-event email. And I just want to also mention, if you enjoyed our seminar today, you can sign up through bit.ly/call conversations events so you can be part of our invite list for our future COL conversations. Again, ladies and gentlemen, global investing is not out of reach anymore. You can already access other markets and diversify from the local market through funds, and you can do that through your COL account. Thank you for being with us this afternoon, and we'll see you all next time.